Hello dear friends. As always, I will share a simple and effective strategy that I have tested multiple times and am confident will benefit you with its high profit margin. I recommend quickly reviewing all the strategies I have shared in my videos so far, because the more different earning models you learn for trading, the faster you can accelerate your earnings by choosing the one that suits you best. Now, let's first optimize our indicators and add them to our chart. But before that, don't forget to subscribe, hit the like button, and turn on notifications to be instantly informed about new videos. Let's get started.
We will be using Hikingashi Candles in this trading strategy. Hikingashi Candles are a technical analysis tool derived from Japanese candlesticks, which is a Japanese style technique. Unlike classical candlesticks, Hikingashi Candles are calculated by taking into account the movements of the previous candles and help to determine the trend direction more accurately. Therefore, Hikingashi Candles can provide a less nosy view compared to classical candlesticks and can identify trend reversals earlier. Let's move on to the trading rules. Rule 1: for a long position, the blue buy signal of the super trend fractals and half trend indicators should be on the same bullish candlestick or onto bullish candlesticks placed side by side. Rule 2: the stop loss level should be below the last swing low. The first target is always at a 1-to-1 risk reward level. If this level is reached, the stop loss level should be moved to the entry point of the trade and some profit should be taken. Now let's take a look at an example of a short position. Here we see two consecutive sell signals from the indicators. This situation meets the conditions. The stop loss level should be above the last swing high. Our first target is at a 1-to-1 risk reward level. As you can see, we took some profit at the 1-to-1 risk reward level, which was our first target for this trade, and when the market turned back up, our trade was closed at the entry level. Let's take a look at another example of a short position. In this trade, we also reached the 1-to-1 risk-reward ratio, but the trade was closed at the entry level. Please note that although achieving 100% success is not possible, we can consistently increase our capital using the trading technique we use. As you can see, we hit the target in this operation.
I think you easily understand the trade rules. If you have any questions in mind, please write them in the comments section. Now let's quickly look at a few examples and then we will modify our strategy. We will still be using an effective system, so please watch the video without skipping it.
Now let's create a different trading strategy. Of course, first we should optimize our indicators and add them to our chart. The trading rule for a short position is as follows. Rule 1. The price must fall below the EMA ribbon lines and then pull back towards these lines again. Rule 2. A trend line is drawn passing through the pullback candlesticks or touching their wicks, and the price must close below this trend line by crossing it downwards. Rule 3. Then, a red block is expected in the Qqe Mod indicator, and the trade is opened at the closing level of the candlestick corresponding to this block. Now let's look at an example of a long position. Rule 1. The price must rise above the EMA ribbon lines and then pull back towards these lines again. Rule 2. A trend line is drawn passing through the pullback candlesticks or touching their wicks, and the price must close above this trend line by crossing it upwards. Now let's quickly look at a few more examples and finish our video. Please don't forget to subscribe, hit the like button, and share the content with your friends. Goodbye.